When we were kids, we used to have a story that would say, you know, if you took a penny today and in 1 year you added another penny, that would be 2 pennies, and every year you doubled it, 2, 4, 8, 16, 32, etc. In 20 years you'd have $1 million some dollars. It has in some cases. Gabriel Wisdom, a dear friend of David and I, has a value fund called the Fallen Angels Fund here out of San Diego, and also is a radio host who we are very fond of. Whitney Tilson, Tilson Funds, does have a lot of the fundamentals of Buffettology within his fund's philosophy. Then there's another gentleman by the name of John Reese, who wrote The Guru Investor, who has a Val Idea Fund. And he was kind enough to give 13 pages in his book to me and David for writing Buffettology, because he developed his methodology through that. David and I recently have joined with a group out of the UK called Leland Sanford. We've licensed them Buffettology Fund in March, brand new, and it's for the European market only, and it has all of the dogma of Buffettology.
Because Warren Buffett said that all he does is to buy business with great underlying economics at a sensible price. So what does he really mean when he says sensible price?
Okay, first of all, companies with great underlying economics. We already know that. We have the debt, it's not carrying a lot of debt. It has earnings that are consistently going in the right direction. It has management generally in place. Warren never really changes management with the shareholders' interest in mind. And it's selling at the right price. Now,
so what's the right price?
Well, you know what book value is.
Yeah.
Book value is for you and your audience, you know, your assets minus your liabilities gives you what your book price is. So he likes to buy $1 for 50 cents. So how do you do that? Well, you're very patient and you're very disciplined. You don't swing at every pitch, to use a baseball analogy. And the best example, it's a long time ago that I can give because I was there, was in the early 80s when RJR, it came out that, yes, tobacco causes cancer. The media was going crazy, the market was going crazy, everyone was overselling the stock. Let's get out of RJR. And I was sitting in Warren's study in Omaha, Nebraska, and I said, my God, you own a lot of RJR. This must be really bad news. And he said, are you kidding? They're going to drive this stock down, and I'm going to step in and buy as much as I can. Because the one thing that people, you know, day traders and so on, forget is there was one other word that went along with RJR, and that was Nabisco, one of the largest food companies in the world. So while the tobacco industry, the tobacco division of RJR, was giving it great profits, just pure cash, Nabisco wasn't going anywhere. And that's when Warren stepped in and bought it. And then he did the same thing with the Washington Post, which was essentially a one newspaper town. You know, that's a consumer monopoly, like the Buffalo News was, although newspapers are not a great business now. But those are great examples. So he waits for the opportunity of a good business with good fundamentals, and it doesn't have to be a sexy business. It doesn't have to be, I mean, H&R Block was a great business. Everybody has to have their taxes done. It's a recession-proof business. When he bought Dairy Queen, I used to make a comment saying he wanted to buy it when he was 8 years old, but the price wasn't right. So he waited 65 years. And I really believe that. I mean, that's the kind of discipline that value investors have to have in order, you want to buy it.
We're just waiting.
By waiting, by knowing. I mean, it doesn't have to be the rock bottom price, but at a reasonable discounted price to book value. Yeah.
In fact, I think this is an interesting point because I've met people who actually bought businesses, but somehow or other they got scared out of the market because the prices was falling. And I was trying to tell them that they have to look at it from a business point of view and not just the price. So I think that there's something to reinforce that point, and I really appreciate that.
Well, yeah, and a business point of view is something that when I taught a class at UCLA, I brought up Yahoo. It was during the business bubble, and it was Yahoo, but it was a lot of companies. And I said, look at the market cap of this company. And the market capitalization is basically the outstanding number of shares and the price of the share.
Yep.
And you multiply them together and you get a market capitalization, a price that the company's worth. And when those internet companies were going sky high, some of their market capitalizations were saying that those companies were worth, let's say, $44 billion. And people were just buying them. But if you went on the other side from a business perspective and you said, how much did this company earn this year? And you see it earned, some of them never earned anything. Some of them earned $1 million, $2 million, $1 billion. So the question becomes, are you willing to pay $44 billion for a company that's earning $1 billion? And of course you're not. And that's business perspective investing. A better stock price for him, better than he can get in the market. So he's happy to have a company put to him, especially if he wants it, and then at the same time pick up a premium if it gets sold. And he doesn't do it a lot. I think it's the options and put market is very much a derivative style market. And as true value investors, we don't dive into derivatives. We just wrote a book called Warren Buffett and the Art of Arbitrage. Now that's something that Warren does an awful lot of in the years where there's bull markets, where there's nothing to buy, and it's a certainty deal. I mean, there's plenty of kinds of arbitrage markets. There's currency arbitrage. Let's say in London, gold is selling for $1,000 an ounce, and in Paris, it's selling for $1,005 an ounce. So you buy it in London, you sell it in Paris, and you make $5. Then there's friendly mergers. Then there's hostile takeovers. There's risks. There's all kinds of arbitrage. Warren prefers a friendly merger because the shareholders are with it, the board of directors are for it, therefore the deal is most likely going to go through. And those are the kinds of, every day there in the newspapers, there are kinds of mergers and takeovers that are announced. And if you're patient and you do with the internet, we have a lot of capability to do the research, to look at this SEC filings, to go through the papers, and to decide, is this something that the shareholders are most likely going to approve and the board of directors? With the Burlington Northern, that happened. Warren offered $100 a share for a stock when it was $76 a share. Everyone wanted Berkshire to own the Burlington Northern Santa Fe. So what happened? The stock rose from $76 a share to about $97 a share. And people that owned it during that time got out because they said, oh my God, if the deal doesn't go through, I'll lose my money. But I'm not willing to hold on to it for another $3. So they made their $27 in profit and got out. One of the things I would have done is ridden that and gotten my $27 profit, maybe have sold it, but then I would have borrowed money on that $3 difference between $97 and $100 that he was going to buy it at a few days later. And that's the interesting thing about arbitrage deals or ops, puts and options. They're generally a shorter length of time, 2 to 3 months, at the longest, sometimes 6 months, but generally short period of time.
I think one key is one key because when we actually educate people on value investing as well as teaching them how to use options, which is a small augment of our class that uniquely define us, there are people who actually came and asked that can I just learn the options part? And my answer is no, because ultimately the basic and the principles is still based on value investing. You have to find the kind of businesses that you want, and options will give you profitable returns if you find the correct business.
That's absolutely correct. You can't have a risky business
That's
and
right.
do an options deal. And the other part of options is that you better have the cash.
Exactly.
You have to have the cash when it's put to you.
Right.
You have to pay for it.
So you must be willing to buy and hold the business.
Ready to buy.
Right.
It's the simplest and the most long-term, low-risk way of accumulating great wealth. And here's why. There's something that Warren, his secret agent is something called compounding. Warren does not pay a dividend on Berkshire Hathaway. And any stocks in his company, any stocks that I own, I reinvest my dividends. Because when you receive a dividend, you receive cash and you receive the tax man at your door. You have to pay tax. When you reinvest your dividend, you're increasing your underlying value of your holdings, right?
Without paying any tax.
Without paying tax, because you're putting it off until you eventually sell it, but you're accumulating it. And here in the United States, when we were kids, we used to have a story that would say, if you took a penny today and in 1 year you added another penny, that would be 2 pennies, and every year you doubled it, 2, 4, 8, 16, 32, etc. In 20 years you'd have $1 million some dollars. Well, that's watching money compound at 100%. Warren's been able to compound an annual compound rate of return of 23% for over 40 years, which is something no one else has done. So the reason that value investing and buying and holding is important, even through the bad periods, that's why it's always nice to have a little cash on hand. All good value investors have a little cash on the side for that buying opportunity. Because when the market falls and when Johnson & Johnson's get some bad news about their hip drug or a few other things go wrong at Johnson & Johnson and their PE ratio drops to 10 or 11, that's not going to happen again for a while. That's when you want to step in and buy. So it's really the magic of compounding. It's the magic of, I sleep very well at night because I don't watch the market every day. The only time I watch the market is when bad news is happening.
Okay, to find the right opportunity rather than being worried about it.
Right. I look at companies constantly.
Right.
David and I search and we look for companies that meet the criteria of a Buffett type company, of a value investment. And sometimes those companies are very boring, as I said. Warren bought one in Israel called Iskar, and it makes a titanium carbide. It just makes this tiny little piece. It cuts these little pieces that goes in every computer, every car, everything in the world, pretty much, has to have this tiny component. And so that was a wonderful investment for him, but who ever heard of them before? Nobody. Once I found a company that just made a little piece of a lever for the car that allows every car to go forward and back, whether it's automatic or manual. And it was a wonderful company, very fairly priced, actually undervalued, and I held that for years and years and made a lot of money on it. So if it's really doing the research. I mean, it's your money. People have to remember, if it's your hard-earned money, you really have to do the research. The stock market is very short-sighted. The Wall Street, the guys who are selling you mutual funds, they want to be the number one mutual fund at the end of the year. They can't hold a position. You know, once I sat down with Wells Fargo's guy in-house and was looking at what was on his books, and I said, why aren't you guys buying cap cities?
Yeah, exactly. Blue companies.
Yeah, in the 80s. And he said, Mary, I wish I could. I can't, because it's not going to turn. At the end of the year, it won't show profit. I said, yeah, but in 10 years, it's going to be worth triple the price. So the market is very short-sighted, where we're very long-term oriented. Yeah, I mean, you are your biggest asset, I believe, and so does Warren, in the world, because it's what you do with your life. But your goals have got to be not about making money. You know, something that I teach my children is the most important thing in life is to do something that you love, to be kind, to be generous, to understand that we're all interconnected in a global sense more and more. And eventually, you know, the ultimate goal is spiritual development. And that means behaving to other human beings like you'd want to behave. But, you know, Warren says when he goes to work, he's going to his pleasure dome. I find very few people who love their work that don't either make good money at it or that are unhappy. Generally, people who love what they're doing are happy and have some money.
Exactly.
I think I'm really impressed with your program and what you ascribe and what your message is, because I think that since I've just recently been in Asia, in Beijing, in Malaysia, and looking forward to coming to Singapore, of course, I think a lot of the young people there and people who are making so much money and working so very hard don't really know what to do with it. And I think your programs of investing in yourself, investing in your own business, looking for the right kinds of businesses to work for, you know, that's another thing that we write about in Management Secrets, is we say, you know, look at where you're going. Ask yourself these questions about a company if you're going to work for it. Do they have a lot of debt? Are they the same questions that you would ask if you were going to invest in a company? Because you're more likely to get a raise, you're more likely to maybe own the company one day. In Hollywood, there were lots of people that started out in the mail rooms, delivering mail, who became heads of studios. But they were doing what they loved. They were in the business that they love. So I think the model of value investing is very important for Asia and Singapore market, because everything is very, I call it net speed. Everybody wants it fast, everybody wants it now. It doesn't really work that way. It takes a long time to earn our money, and it's hard work, and we just don't want to throw it away that way. We want to have it work for us, which is what Warren's done, is make your money work for you. And that, I think, is something that is hard for Asia to understand, from what I gathered from my experience there, which I think is why your program is very important, yeah.